The Green Sheet is a financial publication of the MWRA Advisory Board. The November 2014 installment provides an overview of the MWRA's past, current, and future capital financing costs and the authority's attempts to mitigate the impact of debt service on future years. Capital financing impacts the authority's budget more and more every year, and this video will provide a historical and projected view of capital financing costs, as well as explain how the authority structures its debt. Finally, we'll look at the significant measures being taken to save ratepayer money. This area chart shows capital financing costs in red and all operating expenses in blue, which illustrates that capital financing costs are the driving force behind increasing rates. For some perspective, in fiscal year 1990, capital financing costs made up 38% of the total budget. Those costs became more than half of the total budget in fiscal year 02 and crossed the 60% barrier in fiscal year 14. This also shows projected years through fiscal year 24, which demonstrates that over 60% is the new norm. But what drives these increasing capital financing costs? Capital improvement spending, also referred to as CIP spending, is shown here as a blue dotted line. The dark blue line is actual capital spending by year from fiscal year 86 to fiscal year 14. These two red arrows show the correlation between the drastic increase in capital spending from the end of the 1980s to the mid-1990s and the steady increase that has taken place in the past decade for debt service costs. On the flip side, since many large court-ordered projects were completed in the 1990s, CIP spending has dropped significantly, which will coincide with a drop in debt service after the final scheduled increases come and go. But for a bit of context, you can see here that it will still take over 15 years before we return to current debt service levels. In short, the first graph showed that the budget is driven mainly by capital financing costs, and this graph shows that current capital financing costs were created by past CIP spending, which has begun to taper off. In the broadest context, the authority has spent $7.8 billion on capital improvements since 1985, and $5.7 billion is currently outstanding. The authority has a AA+ rating from S&P, which helps keep interest rates down on long-term borrowing. Getting into the structure of the authority's debt service, this table shows the major categories. On the right, you can see that debt is broken down by sewer and water, with the sewer side at about 70% of capital financing costs. The total outstanding debt is shown here in orange, with the fiscal year 15 total capital financing costs in blue. Let's look at these numbers as a pie chart for a better visual representation. The total capital financing cost for fiscal year 15 amounts to $409.8 million, which is the net amount after offsets. The biggest category is senior debt, which is the long-term borrowing done through bonding. Senior debt is 56% of the total fiscal year 15 capital financing costs. SRF debt refers to the state revolving fund. The majority of long-term borrowing through the SRF is done at a 2% interest rate through state-subsidized loans. Other capital financing costs includes current revenue for capital and repayments on tax-exempt commercial paper, which supports the water pipeline program. Subordinate debt includes variable debt and swaps, both of which are utilized more when market conditions are favorable. Finally, let's look at the two categories at the top, bond redemption and debt service assistance, which represent offsets to total capital financing costs for fiscal year 15, lowering the total cost by 1.8%. Utilizing offsets like these is one way to mitigate the yearly increases in capital financing costs, which continue to drive up wholesale water and sewer rates. For a comprehensive view of how the authority works to lower borrowing costs and manage rates, we'll look at a list of the ways. The authority attempts to maximize their use of the state revolving fund for lower than market rates. Subordinate debt can help lower budgeted capital financing costs when the market conditions provide low variable rates, which was the case in fiscal year 14. Tax-exempt commercial paper is used to fund construction in progress, lowering the rate impact on assets not yet in service. Refunding of outstanding debt can take different forms, but it's a great way to lower future impacts of interest payments when the opportunity arises. Between fiscal year 06 and 14, over $2.2 billion was refunded, providing present value savings of over $100 million. Finally, the defeasance account strategy allows the authority to use year-end surpluses to prepay future debt service, lowering impacts of capital financing costs on future years. Let's look at these methods in action. In June of 2014, a defeasance transaction took place that prepaid $27.2 million in outstanding principal. The transaction correlates to $31.3 million in real debt service savings from fiscal year 15 to 18. In addition, on November 6th of 2014, the authorities sold $243.9 million in bonds, which included $28.2 million to current refund the 2004 Series B bond. and $142.6 million to advance refund 6 outstanding bonds for interest rate savings. Those savings will provide $23 million in debt service reductions between fiscal year 15 and 20, and $33.4 million from fiscal year 21 to 42. Considering the concern over the increases of capital financing costs in the next 5 to 8 years, this is over $50 million saved in that period. To put these efforts in perspective, let's look at the impact of defeasances since fiscal year 06. On the bottom, you'll see the years in which defeasance transactions took place, which correspond with colors in the bar graph. These are the savings from defeasance transactions. In total, between FY06 and 14, almost $315 million was defeased or prepaid, lowering the impact on future years. Again, looking at the fiscal year 14 defeasance transaction just discussed, it will save $25 million in fiscal year 17 alone, a year that was specifically targeted because it is projected to require a significant rate increase. This is a prime example of the ways in which the authority is aggressively attacking capital financing costs in an effort to manage rates. This was a brief look at how the authority structures its debt and what is being done to address rising costs. If you have further questions, please contact us directly or visit our website at www.mwraadvisoryboard.com.